Looking at the third transaction, a non-current asset with a carrying amount of $20,000 was sold for $28,000 on the 1st of June. So that is in the current financial year, and there's an unrealized profit of $8,000. After tax, it gives an amount of $5,600. Okay, Piano regarded the item as inventory and still had the item on hand at the end of the financial year. So at the end of the financial year, this profit has not yet realized. Only when this non-current asset is sold to an external party in the following year will we realize that profit. So we have to reduce the profit of the associate with this amount. The fourth item was also occurred in the previous financial year. So on the 1st of July, Piano Limited sold an item of machinery to Mandolin for $6,000. So that was the selling price, and it was an asset item that was sold. This item cost them $4,000. The investor company Piano regarded this as inventory, whereas the associate intended to use this as a non-current asset, and therefore they depreciated at 10% per annum. So in this case, there's also a $2,000 unrealized profit at the that was adjusted for in the previous financial year's calculation. What affects us in the current year is the depreciation charge on that. So the depreciation is $200 a year after tax. It's also an amount of $140. Okay. And once again, through using the asset, and as it is reflected in the depreciation rate, we're realizing the profit on that inter-entity transaction. Okay, so let's transfer these calculations now onto the calculation to determine our share of the associate's profit and loss. So what do we know? We know that the profit for the year was an amount of $100,000. The first transaction that we looked at was the realized profit on the non-current asset that was sold to Piano Limited, and that was depreciated at 10% per annum. So as we depreciate the asset, the unrealized profit starts to realize. So it's an adjustment of $140. The next item was the piece of plant, the item of plant that was sold in the current year. So there were two components to that. First of all, an adjustment for the unrealized profit of $3,000 after tax. So we had to, which is included in this figure. So we have to subtract it from the profit for the year. But then for 6 months, that plant item was depreciated. So there is a portion of the unrealized profit that it actually started to realize for an amount of $158. The next item was the non-current asset that was sold during the year by the associate to the investor, and it was still on hand as inventory by the end of the year. So we just need to adjust for the unrealized profit of $5,600. once again, that profit is lying in the profit for the year of the associate, but from a group perspective, although this is not technically a group, but from the group perspective, that profit has not realized because the inventory item hasn't been sold to an external party, so therefore we deduct it from the profit. The last item is the realized profit on the item of machinery that was sold. It was inventory in the hand of the investor. It was now sold to the associate who's intending to use it as a non-current asset. So as the associate depreciates that asset, so does the unrealized profit start to realize from a group perspective. Okay, so this then helps us to calculate the investor's share of the associate's profit and loss for the year. So if I'm correct, this should be a total of 92,738. The investor has a stake of 25%. So the investor's share of the associate's profit for the year is then 23185 approximately. Okay, and that is one of the entries then that we'll pause to increase our investment in the associate. So to reflecting the fact that we've got a higher value of investment then in the equity of the associate at the end of the financial year. Okay, so let's look at the journal entries that we'll pause in this example. First of all, with regards to our share in the associate's profit and loss, would be to debit our investment in Mandolin and credit share of profit and loss of associates and the amount was 23185. So 23185. The other two entries that we need to consider is then the dividends. In this example, it was 2 dividend payments that were made. So we actually received the cash, the investor. And because this investor is not consolidating or preparing consolidated financial statements, no dividend revenue is recognized in the accounts of the investor. However, the journal entries that he'll pass is with regards to the first dividend payment, debit cash, because we've received the money, and the dividend was $10,000, so our share is $2,500. And credit, we reduce our investment in the associate, because when we pause this entry, we work with a profit figure before any distributions to the shareholders. Okay. And the last one is the interim dividend that was paid of $8,000. So once again, debit cash, credit our investment in Mandolin. 25% of the 8,000 should be, 2,000. Okay. If any of these were dividends that were declared but not yet paid, this entry would have been dividend receivable. Okay, dokes. Please let me know if there's anything further that you need clarity on. You're more than welcome to then post a question in my guru where we'll be able to respond to it.